January 26th, 2026. Physical silver vaults across 3 continents are experiencing something that has never happened in modern financial history. Not a panic, not a squeeze in the traditional sense, a structural evacuation. In 7 days during early January, 33 million ounces vanished from COMEX registered inventory, 26% of available supply withdrawn in a single week trading key. This is not speculation moving prices. This is the market's operating system being rewritten in real time while you watch. The price reached $92.91 per ounce. Gold simultaneously broke through $5,000. Bitcoin recovered to $87,000. But the number that matters most is not the price. It is the inventory number. Because when the physical metal leaves the vault, when ownership converts from paper claim to physical possession, when 26% disappears in 7 days, you are witnessing the exact moment a market crosses from theoretical pricing into survival-based bidding. This is not a rally. This is a recognition event. The recognition that the paper promises, made over decades, cannot be kept. The recognition that industrial civilization's most critical conductor of electricity exists in quantities far smaller than the contracts written against it. The recognition that time itself has become the enemy. Because every day of settlement delay is another day someone else takes their metal and leaves the system entirely. We need to talk about why this is happening right now, not why silver is going up, why the physical metal is being pulled out of the ground, out of vaults, out of the entire paper trading system, faster than new supply can possibly replace it. Industrial demand now consumes roughly 550 to 600 million ounces annually, while total global mine production has stabilized around 820 million ounces discovery alert. 3/4 of all silver mined goes directly into applications that destroy it. Solar panels that last decades, electronics that get buried in landfills, medical devices that cannot be recovered. What is left for investment, for monetary holdings, for the paper market's promises? The remainder. And that remainder is vanishing. The cumulative deficit since 2019 now exceeds 1.3 billion ounces SD bullion. Every ounce of that deficit came from somewhere. It came from the stockpiles, the inventories that everyone assumed would always be there. COMEX registered inventories have fallen nearly 70% since 2020, while London vaults have lost around 40% of their holdings FX Street. Shanghai inventories sit at decade lows. Some industrial regions operate with 30 to 45 days of accessible reserves. This brings us to the most dangerous signal in the entire structure, the ratio between paper claims and physical metal. The paper to physical ratio stands near 356 to 1, meaning for every ounce of physical silver, there are 356 ounces worth of paper claims circulating FX Street. This worked when everyone agreed to play the game, when ETF holders were content with the digital entry, when futures traders rolled contracts forward rather than demanding delivery, when the monetary system's promise of equivalence between paper and physical was simply accepted as fact. That acceptance is dying, not because of conspiracy, not because of manipulation, because of mathematics. Because when you write 356 promises against one piece of reality, you are not creating a market. You're creating a liquidation schedule. You're deciding who gets the metal and who gets the apology. And that decision is being made right now, in real time, by whoever moves fastest. Now we need to talk about what actually broke the system. On January 1st, 2026, China implemented export restrictions, allowing only large state-approved companies with annual production capacity of at least 80 tons to export refined silver after obtaining special government licenses, FX Street. China produces approximately 1/6 of global supply. But the restriction affects something far more important than production. It affects the flow, the movement of metal that papered over supply gaps for years. China's export controls have effectively cut off 60 to 70% of global refined exports, fragmenting the market from integration to regional breakdown trading key. London cannot refill stocks. New York cannot source metal for delivery. The Asian premium over Western paper prices has blown out to unprecedented levels. Physical silver in Shanghai now trades above $80 per ounce, while COMEX futures trade far lower FX Street. This is not a pricing disagreement. This is the market bifurcating into 2 separate realities, one where silver exists as a physical substance, and one where it exists as a contractual promise. The moment that bifurcation becomes permanent, the moment the paper price loses its authority over physical settlement, the futures exchanges lose control of price discovery entirely. This is exactly what happened in lithium, in rare earths, in every commodity where physical scarcity revealed paper markets to be calculation exercises disconnected from deliverable supply. The difference with silver is scale. The difference is that silver sits at the foundation of the electrical grid, the solar infrastructure, the artificial intelligence hardware build-out, the electric vehicle revolution. The difference is that silver's industrial consumption is utterly inelastic. Manufacturers do not stop buying because the price doubled. They cannot substitute. Silver is indispensable at scale with no readily available cheap substitutes, Wales book. They buy at any price or they shut down production lines. This is where the system breaks. Because when you combine inelastic industrial demand with collapsing inventories with a paper market levered 356 to 1, you do not get a managed adjustment. You get a forced reconciliation. Someone must not get their metal. Someone must accept cash settlement. Someone must realize their claim was never real. And when that realization spreads, when the authorized participants who create ETF shares cannot source metal, when redemptions are suspended, when lease rates spike to levels above 5% and even higher during acute stress. Bullion Star, you're not watching a commodity trade. You're watching confidence leave a system. Most people believe they own silver. They see it in their brokerage account. They hold ETF shares. They watch the price move. But most silver ETFs rely on complex structures involving authorized participants, custodians, sub-custodians, leasing arrangements, and unallocated metal that functions smoothly under normal conditions, but fracture under physical stress. Bullion Star. When physical silver becomes scarce and lease rates rise, authorized participants may be unwilling or unable to source metal for creation or redemption. The ETF shares continue trading, the price continues moving, but the metal, the actual metal, has effectively disappeared from the market. The investor believes they own silver. In reality, they hold a paper claim with growing counterparty risk, and that counterparty risk is not theoretical. It is not distant. It is materializing right now in the form of inventory drawdowns, lease rate spikes, persistent backwardation, and vault withdrawals. Between early and mid-January, in just 7 days, 33.45 million ounces of silver were physically withdrawn for delivery, representing roughly 26% of COMEX registered inventory disappearing in a single week trading key. This is how paper markets break, not through a single dramatic default, not through an announcement, through gradual loss of credibility as physical metal flows out of Western vaults and into regions willing to pay real premiums, through the slow recognition that the warehouse receipt is not the same as the metal itself, through the dawning understanding that time is not neutral, that settlement delays matter, that every day you wait is another day someone else takes delivery and you move further back in line. But there is something even more important happening beneath the surface, something that changes the entire character of what silver represents in the financial system. Central banks are beginning to accumulate silver, not as a tradition, but as recognition of its strategic and monetary value trading key. For 70 years, the rule was simple. Central banks buy gold, not silver. Gold is the ultimate monetary reserve. Silver is industrial byproduct. That distinction is collapsing, not because silver has suddenly become money, because the geopolitical system that made that distinction possible is fragmenting. Russia, under sanctions, cannot hold dollars. Russia confirmed central bank allocations for precious metals, including silver, while the United States officially designated silver as a critical mineral in 2025 Discovery Alert. When a sovereign nation designates a commodity as critical, it is signaling something very specific, that access to this material is a matter of national security, that supply chains cannot be trusted, that even allies cannot be relied upon to maintain flows during crisis. This is the second front of de-dollarization. The first front was gold. Central banks accumulated over 1,000 tons per year, draining Western vaults, establishing bilateral trade flows that bypassed dollar settlement. But gold is too expensive for industrial scale. Gold does not power solar arrays or data centers. Gold does not flow through the circuit boards that run artificial intelligence training clusters or autonomous vehicle networks. Silver does. And when emerging market central banks recognize that the monetary metal and the strategic industrial metal have converged into the same substance, when they recognize that holding silver is holding a claim on the electrical infrastructure of the next 3 decades, the demand profile changes completely. This is not speculation. This is not even investment in the traditional sense. This is stockpiling. This is the recognition that global supply chains have entered a permanent state of fragmentation, that free trade is dead, that every nation must secure its own access to critical materials or face the consequences of dependence. And when nations begin competing for physical silver against industrial manufacturers who cannot substitute, against paper market holders who are belatedly demanding delivery, the mathematics become very simple. Someone does not get metal. Someone accepts cash settlement at prices that were agreed upon before the system broke. We need to talk about what this means for the one asset everyone assumes is safe. Cash, dollars, the default option. Because holding cash during this transition is not neutrality. It is a bet that the paper system will hold, a bet that contracts will be honored at prices negotiated before scarcity became visible, a bet that inflation will not accelerate, a bet that the currency itself is not what is being debased by the very dynamics driving hard assets to record levels, gold rose 85% in the past year. Silver surged 234%. Bitcoin climbed 150%. Supply deficits reached 1.17 billion ounces, with demand exceeding 1.17 billion ounces against mine supply of approximately 835 million ounces in 2025, marking the fifth consecutive year of shortage, the Oregon Group. These are not isolated moves. These are not different asset classes reacting to different factors. These are three separate ways to exit the dollar system, and they are all moving in the same direction simultaneously. When stocks and gold rise together, when risk assets and safe havens rally in parallel, when everything priced in dollars goes up at the same time, what is actually happening is not that assets are appreciating. It is that the unit of measurement is failing. The dollar has dropped 9% against major currencies in 90 days. But that index measures dollars against other currencies, euros, yen, pounds, all of which are being printed at comparable rates. What you cannot see in currency indices is the real debasement, the decline in purchasing power relative to finite resources, relative to gold at $5,000, relative to silver at $93, relative to the physical commodities that cannot be printed. Every central bank is running the same playbook: cut rates to support growth, inject liquidity to prevent financial instability, allow inflation to remain above target because the alternative is recession or debt crisis. The Federal Reserve cut rates to 3.75 to 4.00% FX Street, despite inflation persisting above the 2% target. This is not policy error. This is the only option available when government debt exceeds 130% of GDP and annual deficits run north of $1 trillion, regardless of economic conditions. You cannot finance that with tax revenue. You cannot finance it with legitimate borrowing. You can only finance it by debasing the currency, by allowing inflation to eat away at the real value of the debt, by transferring wealth from savers and cash holders to debtors and asset owners. This is not conspiracy. This is public policy. This is the explicit goal of financial repression: to make the real interest rate negative, to make holding cash a guaranteed loss, to force capital into risk assets, real estate, equities, commodities, anything that maintains value as the currency unit shrinks. And that is exactly what is happening right now, not in theory, in practice. The 10-year Treasury yields below 4%, while official inflation runs at 2.7%. But that official number excludes food and energy volatility. It excludes housing costs calculated on owner-equivalent rent rather than actual home prices. It excludes the reality that anyone buying groceries or paying insurance premiums or replacing a vehicle knows the purchasing power of the dollar is declining far faster than 2 to 3% annually. So when silver rises 234%, the question is not why silver is going up. The question is, what is silver telling you about the value of the currency unit it is priced in? The question is whether you believe a paper contract backed by a fractionally reserved vault system levered 356 to 1 will be honored at prices that existed before the shortage became visible. The question is whether you trust that the system has enough metal to satisfy all claims simultaneously if everyone demands delivery at once. The market is answering that question right now, in real time, with inventory data. COMEX has shed nearly 70 million ounces in just a few months, SD bullion, with backwardation showing spot prices above futures, indicating immediate demand exceeds future supply expectations, with lease rates spiking to levels that make borrowing metal prohibitively expensive, with regional premiums in Asia creating entirely separate price structures, with silver refiners building up significant backlogs as demand for both large bars and retail products exceeds processing capacity. Bullion Trading LLC. This is not market manipulation. This is not artificial scarcity. This is the physical world imposing limits on the financial system's paper promises. This is geology and energy and transportation infrastructure revealing that metal cannot be summoned into existence by monetary policy, that printing currency does not create silver, that writing contracts does not increase supply, that at some point the ledger must reconcile with physical reality and someone must accept they do not actually own what they thought they owned. The most critical indicator to watch moving forward is not price. Price is the outcome. The critical indicator is the ratio between registered inventory and open interest. The critical indicator is the spread between physical premiums and paper futures. The critical indicator is whether authorized participants continue creating new ETF shares or whether creation suspends because metal cannot be sourced. The critical indicator is whether cash settlement becomes voluntary or mandatory. If the system holds, prices consolidate. Volatility declines. New supply comes online over the 8 to 12-year timeline required to bring mining projects to production. Industrial demand moderates through substitution and efficiency. Everything returns to normal. But if the system breaks, if confidence in paper claims evaporates, if redemptions cascade, if physical shortages force industrial buyers into panic bidding, if central banks accelerate accumulation, if the paper-to-physical ratio collapses from 356 to 1 down toward anything resembling legitimate backing, then the repricing is not measured in percentages. It is measured in multiples. Major analysts now openly discuss silver above $100 as plausible, not as speculation, but as consequence of structural realities, with some scenarios suggesting ranges of $100 to $200 by early 2026, the Oregon Group. These are not fringe predictions. These are institutional forecasts based on supply deficits, inventory depletion, industrial demand that cannot be deferred, and monetary conditions that make holding cash a guaranteed wealth destruction vehicle. We are at the moment of recognition, the moment when the difference between paper and physical becomes unavoidable, the moment when settlement time becomes the critical variable, the moment when the question is not what price you will pay, but whether you can get delivery at all. This is January 26th, 2026. Physical silver vaults cannot keep up with demand. The registered inventory is draining at unprecedented rates. Industrial consumption is utterly inelastic. Central banks have entered the market as strategic buyers. Paper claims outnumber physical metal by margins that cannot survive stress testing. And the global export flows that papered over structural deficits for years have been severed by policy decisions that prioritize domestic needs over international supply chains. You are witnessing the end of one regime and the beginning of another. The regime where paper promises were treated as equivalent to physical possession is dying. The regime where scarcity is priced in real time by whoever is willing to pay for guaranteed delivery is being born. This is not about whether you should buy silver. This is about whether you understand that the financial system's operating assumptions are being invalidated by the physical world's constraints. That time itself has become hostile to paper holders, that every day of delay is another day someone else takes their metal out of the vault and you move further back in the line. The decision is not between action and inaction. The decision is between accepting the system's promise that everything will settle normally and recognizing that normal ended the week 26% of registered inventory vanished in 7 days. The decision is between believing that 356 claims can be satisfied by 1 ounce of metal and understanding that mathematics has no mercy. The decision is between holding a currency that is being deliberately debased to service unpayable debts and holding something that cannot be printed, cannot be promised into existence, and cannot be found in quantities sufficient to meet the demand already locked into industrial build-outs that span decades. This is the message from the vault. The metal is leaving, the paper remains. And the difference between the two is becoming the defining trade of the decade.